Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about whether or not I think investing in Chinese companies is too risky. I get asked all the time, should I invest in this Chinese company? You know, Alibaba, JD, Tencent. What are my risks? Well, listen, if you know anything about Rule 1 investing and know what I've been teaching for years, you should already know what my basic stance on any company is, and maybe especially a Chinese company. I mean, that's what I'm going to discuss on this video. So let's get started here. So a lot of investors in the United States have looked at China in recent years, kind of in the hopes of finding the next Tesla or Amazon or Netflix. And one of the reasons for that is because the Chinese market is growing really fast, all of it. Right? In America, we're growing maybe at 1.5%, 2%, something like that. China on a bad year is growing at 6%, which means the tide's coming in for all Chinese companies. So there's obviously a really, really strong reason to be looking there for a great company to put money in. So we do it too. I look at China all the time. In fact, I sent one of our analysts over there not long ago to take a look at a couple companies and get feet on the ground. So you guys know there's a real common phrase, right? This is the Netflix of China. This is the Amazon of China, right? So this is largely due to the idea that the Chinese government has kind of isolated its market from all the rest of the world. So whereas Amazon's all over the world, then Alibaba becomes the major stock of China that's doing the Amazon kinds of things. So there are really kind of interesting companies over there, no question about it. I mean, interesting enough for us to look at it really seriously. But we've basically found there's some serious risk when looking at Chinese companies. I think really the biggest one is that there's just a major lack of transparency and regulation. The Chinese stock market doesn't require the same kind of transparency as is required by Western, and particularly American and Canadian stock markets. Our securities people make sure that you are putting out, if you own running a company, you're putting out all the information that your investors have to have. That is simply not the case in China. And as a result, there's been a number of scandals with Chinese companies that simply cook the books and just make stuff up and then put it out as if it's real. And the problem, and you may not be aware of this, but the problem is that China does not allow United States auditors to come in and audit a Chinese national company. So you don't get to go see what's really going on at Alibaba or what's really going on at JD. You just got to take their word for it. Now, those companies are pretty well known to have not been cooking their books, but others are maybe not so well known, not so well regulated, and several public companies that were listed in the U.S. market have gone into bankruptcy after the CEO did some heinous stuff with the accounting. So if you don't know that numbers are real, then what can you do? I mean, you can't just, I guess you could gamble, but it certainly isn't investing, right? So that's one huge risk is the sort of the accounting that goes on in China. Now, another one is that we are kind of entering a lot of conflict between the United States and China. This is kind of a natural progression that is, it's just common through world affairs for, you know, the last hundreds and hundreds of years. And that is as an aging power starts to begin to devalue its currency, as the United States is doing now, as it starts to slow down its growth, as it starts to have conflicts all over the world that drain its bank accounts, then it's possible at that point for a younger, more vibrant, more aggressive country to start coming up and challenging for world power. And that, of course, happened in a sort of friendly way between the United States and Great Britain, turn of the 19th century through World War II, when the United States basically then took over Britain's standing in the world. And now it's happening between China and the United States. Now, one of the major reasons that's happening is because China has gone to Singapore to get a lesson on how to run a country's economics. Singapore started off as, and you guys know Singapore, of course, is relatively near China, down out at the end of the Malaysian Peninsula. And Singapore is rather famous for having a very powerful leader named Lee Kuan Yew, who, when the country was basically given its independence from Malaysia in the early 1960s, decided that they would create a incredibly vibrant economy out of virtually nothing. All they had there was a port. They have no natural resources. It's just an island with about 4 million people. But they have extremely high work ethic. And he set up a series of economic structures that turned out to be really effective. He went and he basically got information from Friedman, University of Chicago, on how to run an economy, and then went forward on it aggressively and created essentially a fascist type economic system. Now, I know that's really a bad buzzword, but I'm going to use it as an economic statement, okay? Fascism was thought back in the 1920s to be a really brilliant improvement on capitalism. If you've done your history a little bit, you know that at the turn of the 1900s, there was an enormous shift off of the farm into the industrial world, and industrialists at that point in time were on survival mode, and they kept their workers on survival mode. And there were a lot of tough things that were happening out there to people who were working. And so, and one of the toughest was that these companies would rise up and then collapse, with the calamity economically that happens from that. All the workers get fired, all the people lose their money, and it just seemed a really, really inefficient way to run a country. And I mean, there were a lot of people that thought fascism was an improvement. Fascism at the time had nothing to do with Hitler, and people argue he wasn't even a fascist. But it had a lot to do with Mussolini and the idea that Italy could convert itself into a vibrant economy if it had a very strong centralized government that was effectively choosing the winners and losers, preventing economic competition, and making sure workers would get properly paid. And so there was a lot of people that thought that was a great idea. Well, Lee Kuan Yew basically implemented that. And there's a famous thing that's from Plato's many dialogues that he wrote, where he was talking about the most efficient form of government. And he thought the most efficient form of government, this is 2,500 years ago, the most efficient form of government is simply an enlightened king. So, of course, the key word there being enlightened is, if you have anything else, you know from the history of the world that monarchs tend to be more unenlightened than your average Joe and can create havoc around the world. And as a result, monarchy didn't turn out to be all that great of a deal, and we ended up with democracies as a solution to all the problems of monarchy. But the reason monarchies sort of are terrible is because their leaders aren't enlightened. So here we have Singapore with a leader named Lee Kuan Yew, who he recently died. I mean, this guy was as enlightened as it gets when it comes to creating a really successful country from scratch. And so, yeah, he kept a heavy hand on it, but it was a phenomenal success. And Singapore went from being number 110 in the list of wealthiest countries, it was at the very bottom in early 1960s, to become today, I think it's number 3. So this is remarkable, right? This has been one of the biggest economic revolutions in the history of the world, all created by a kind of enlightened fascist government. Well, China looked at this. China's classically a communist government, right? Which is where you distribute, essentially the workers run the business, run everything, right? And from everybody according to their ability and to everybody according to their need is kind of the mantra of Marxism. It sounds good on paper, but it's extremely difficult to implement in the real world, and usually results in the deaths of millions, if not dozens of millions of people. And that certainly was the case in Russia, and it was certainly the case in China. And really, the Chinese in the last 50 years were trying to come out of that horrific result of using Marxist philosophy and Marxist economics. And what they did was look at Singapore and they said, wow, this is really working down there. Let's do that. And as a result, they opened up the country to capitalism. So fascism is simply a central government that controls everything, but it's capitalistic economic system underneath that. And China decided to experiment with that over the last 40 years and has been extremely successful with it. And they're continuing to be extremely successful with it. So The Chinese have implemented an incredibly effective economic system, bringing out of utter poverty hundreds of millions of people. And no one, I mean, if Singapore was a big deal, China is a big deal on massive steroids. And they are going to be the biggest economy in the world, certainly in our lifetime. So this is huge. And they are, as a result, challenging America for leadership in the world as their consumers start to have more money, their middle class starts to grow, and they become more influential in the world. So you have this rising power, this sort of sliding power, and they're facing off against each other. And this is creating a lot of strain in the relationship that is needed to be comfortable in order for us to invest in China. So this is a kind of long way around of telling you another of the risks there is that we end up with something that's a Cold War, where China just decides to shut off American investment to Chinese companies. I don't know if that's going to happen. I hope it doesn't. I think there's an awful lot to be gained by continuing to be trading partners with China. But China has started to really flex its muscles. And as Trump was pushing back on the terrible balance of trade we have with China, now the Chinese are pushing back on the Biden administration saying, screw you, we're just going to keep doing what we're doing and you're just going to have to tough it out. So we'll have to see this comes out. If it gets into a hot war over something like Taiwan, which China wants to absorb back into China, a part of China that broke out and broke away in 1945, then this could really become a big problem. So I'm not advising you guys here. This is just my opinion. But listen, investing in what you don't understand or what you can't predict easily is just gambling. That's all there is to it. So I'm just going to encourage you, do your due diligence. And this is really the way Rule 1 investors can invest with more confidence and less risk. Really dig in. If you're going to invest in China, I would strongly recommend you go there and check out the company. Make sure it is what you think it is. Kick the tires. Don't just go based on what you see on paper. So since most of you probably aren't going to do that, most of you shouldn't be investing in China. Now, I'd love to hear from you guys. Do you think investing in Chinese companies is too risky, or are you gung-ho to do it anyway? So leave a comment below with your answer. I'll be sure to follow up with you. And thanks for watching, you guys. Now go play. Hey, if you enjoyed this video and you feel it was valuable in teaching you more about whether or not I think investing in China is too risky, then hit the like button and please share the video with your friends. And if you want more investing content, just subscribe to my channel. We got a lot of stuff there. And don't forget, click the button and you get a free gift. Thanks again for watching.